investments. My name is C.A. Kothroy, and today we are going to go through this topic together, and we are going to understand how to take advantage of various tax saving expenses and investment. Furthermore, we are going to learn about what are the key things that should be kept in mind while declaring the investment. Furthermore, we are going to take a look at comparative analysis between the new tax regime and the old tax regime. And in the meanwhile, if you have questions, then one of my colleague is here in the chat box with us, and he will be answering your question live. Now, his name is Rahul, and he is a qualified professional. Now, let's take a look at today's agenda. Firstly, we are going to understand when you should be filing your income tax return if you have not done it yet. Further, we are going to look at uh, the old tax regime, what benefit it can give us, and how best we can save some taxes using various options available to us as mentioned in the Income Tax Act. We are going to look at one of the key tax saving instrument, that is ELSS, and what are the benefits of it, what are the tax saving options available for us beyond ATC, and we are going to look at the tax saving proof submission. And along with the way, at the end of the session, we are going to have a little bit of discussion regarding a couple of things that you should be keeping in mind uh, during the year for your financial well-being. Now, firstly, let's try to understand when should I be filing my income tax return. Ideally, the income tax return should be filed within the due date, that is 31st of July of every assessment year. Now, presently, we are in the assessment year 22-23. Therefore, the time to file your income tax return for assessment year 2022 and 23 was 31st of July 2022. However, if you have missed the due date, or you have omitted certain income or deductions in your earlier filed original income tax return, in that case you have the option to file a revised tax return or file a belated tax return. However, these two things, either filing a belated tax return or filing a revised return, must be done within 31st of December 2022. Beyond this date, you will not be able to file your income tax return normally. So, for financial year 2021 and 22, the normal due date was 31st of July. However, if you have missed the due date, you can still file the income tax return till 31st of December 2022. However, one thing you should be keeping in mind, that since you are filing the income tax return belatedly, there will be a penalty chargeable on you, right? Based on the income, this penalty amount can be 1000 rupees or 5000 rupees, right? So if your income, taxable income, is beyond 5 lakh rupees, in that case 5000 rupees will be the penalty. If it is not more than that, then 1000 rupees will be the penalty. Furthermore, if you have some tax payable coming, in that case also some interest may be charged for you. Further, over I would like to mention a couple of things, because this is a very interesting thing that is going to happen, or that is still happening. That is, the income tax department has introduced a ITRU filing. That is, for last two financial year, if you have not filed your income tax return, or you have forgot to include certain income in your income tax return, you will be able to file the income tax return in the form of ITRU. That is, income tax return, updated income tax return. However, there is a catch to it, that if the income tax return which is being updated is more than 12 months old, but no more than 24 months old, in that case you need to pay 50% of tax as penalty on along with the tax due the interest. And if it is less than 12 months old, in that case 25% will be the penalty percentage on the tax due and the interest. Couple of things we should be also keeping in mind, that if you are not filing your income tax return, what will happen? Now, if you are not filing income tax return for consecutive 2 months, in that case you can face a higher rate of TDS deduction, which will effectively reduce the amount that is coming on your bank account. Now, this particular provision does not apply on the salary income. However, this extends to all the other incomes such as FD interest, the dividend, etc., etc. So, if you are not filing your income tax return for a period of 2 years, in that case, you will be liable for higher rate of TDS. Now, having understood uh, the income tax returns due date when it needs to be filed, and what are the repercussions and what are the remedies of filing the income tax non-filing of the income tax return. Now let's try to understand the tax regimes. Now, as it stands, India at this moment has two tax regimes. One is the new tax regime, another is the old tax regime. Overall, if we put it very simply, under the old tax regime, you get to take all the deductions. The deductions like HRA, LTA, standard deduction, tax on profession, your LIC premiums, medical insurance, home loan interest, etc., etc. Everything can be claimed under the old tax regime. However, under the new tax regime, none of these deductions are available except for NPS of employer contribution. But one regime gives you all the deductions, another gives you very little in terms of deduction. So, what is the benefit for it? As it turns out, under the new tax regime, the tax slab rates are much more closely stacked. Number two, tax rates are also increased at very minimal interval, right? So, as compared to the old tax regime, wherein if your income is beyond a certain limit, say for example it is beyond 5 lakh rupees, then you can see a sharp incline of tax rate, that is 15%, right? From 5% direct to 20%. And if it is more than 10 lakh rupees, it goes another 10%, it goes to 30%. However, under the new tax regime, the increments are much more closely stacked. How, despite having the tax rates, lower tax rate and slabs are closely being stacked, people are not opting for new tax regime. Why? Most of all, because there are no deduction for any tax saving investment or expenses. This is the main reason people are not opting for new tax regime. There can be multiple reasons for this, because from our childhood we have seen our parents saving their money either through PF or tax saving FDs or medical insurance, any of these, right? So it's been ingrained in us from the very beginning that we must invest, even though we are not getting any tax benefit or not. Whether we are getting any tax benefit or not, we must save. And this is the reason people, as soon as they started getting into work, they get a employment, they start planning their saving, even if they are not saving actively, but they start saving their money. And this is the reason, after having employment for few years, people have a considerable tax saving investment or expenses. Now, we have talked about only the theoretical portion. Now, try to understand what it actually means if we put the numbers in the calculation. For this purpose, we have taken a hypothetical situation wherein a person whose salary is 10 lakh rupees, right? His salary is uh, divided in three components: basic, HRA, and other allowance, right? We are also assuming that person is staying on rent and that person is staying in a non-metro city, for example, Bangalore, right? Now, if we look under the new tax regime, there is no deduction whatsoever. However, the old tax regime, under the old tax regime, from 10 lakh rupees of his gross salary, we are easily able to deduct 1 lakh 90,000 rupees as HRA deduction. We are also getting a deduction of 50,000 rupees, that is your standard deduction. And we are also getting a professional tax deduction of 2,400 rupees, right? After taking all this deduction, the total salary is coming to 7,57,000 rupees as compared to the new tax regime wherein my total salary is also staying at 10 lakh rupees, right? Under the new tax regime, there is no deduction, but old tax regime gives me insurance premiums benefit, ELSS benefit, Sukanya Samriddhi Yojana's benefit, employer provident funds, medical insurance, everything combined together. I am arriving at taxable salary of 6,19,000 rupees. Whereas under the new tax regime, my taxable salary is still at 10 lakh rupees, right? So my taxable salary is reducing by a considerable margin under the old tax regime. But that does not give me the complete picture. We need to look at what is the tax payable coming in under both the new tax regime and the old tax regime, right? So under the new tax regime, up to 2,50,000 rupees, there is no taxes as the tax rate is zero, which is similar to the old tax regime, right? From 2,50,000 to 5 lakh rupees, the rate of tax is 5%, which is giving me a tax of 12,500 rupees. Again, these are in line with the old tax regime. However, beyond this slab, the picture changes, right? So under the new tax regime, from 5 lakh rupees to 7 lakh 50,000 rupees, the rate of tax is 10%, which is giving me a tax of 25,000 rupees. And from 7 lakh 50,000 to 10 lakh rupees, the tax rate is 15%, which is giving me a tax of 37,500 rupees. All in all, my total tax payable is coming to 75,000 rupees under the new tax regime. Whereas under the old tax regime, 12,500 rupees is up to 5 lakh rupees. Beyond 5 lakh rupees, my taxable salary is increased by only 1 lakh 19,000 rupees, right? Which will be taxed at the rate of 20%. So on 1,19,000 rupees, if I consider 20% tax, it will give me 23,800 rupees of taxes, right? So all in all, I will be paying around 36,000 rupees of taxation. If we add education cess, health and education cess, under the new tax regime, it will be coming to 3,000 rupees, but under the old tax regime, it will be coming to 1,450 rupees, 1450. All in all, I will be paying 78,000 rupees under the new tax regime, but under the old tax regime, I will be paying 37,750. So there is a tax saving of 40,000 rupees, around 40,000 rupees under the old tax regime. So clearly it is seen that if you have a lot of tax saving investment and expenses in your hand, in that case, uh, old tax regime might be beneficial for you. However, the data will change, the situation will change based on the salary figures that you are getting. So before choosing any of these regimes, be sure to check which might be beneficial for you. Couple of things over here I would like to mention: that selection of regimes to your employer happens at the beginning of the year. However, during the year you cannot switch back to one regime to another, from one regime to another one. However, switch out is possible at the time of filing your at the time of your income tax return. And even if you are filing, if you even if you are opting for new tax regime at the beginning of the year, at that time of filing your ITR, you can easily switch it to old tax regime. However, in case you have business income, then this switch out is a bit tricky. If you do not have any business income, then switching in and switching out is pretty simple. Every year you can do that. But if you have business income, in that case, you can opt into new tax regime only once in a lifetime, or you can opt out of new tax regime only once in a lifetime in case you have business income. Excuse me. Now, couple of again another point. Uh, if you have some FNO transaction during the year, that actually counts as business income. Therefore, if you have done some FNO transaction, be sure to understand which tax regime is going to be much more beneficial for you. This will take a lot of deliberation from your end to understand and adopt to a new tax regime or old tax regime. So before uh, opting to new tax regime or old tax regime, whatever it may be, give it a thought and think about your future. What is going to happen? Moving on. As of now, we have understood uh, what is the new tax regime, how it plays out as compared to the old tax regime. Now, let's try to understand what are the tax saving expenses that can happen. First of all, firstly, we have taken a deduction of 1,90,000 rupees from the salary in the form of HRA, house rent allowance. Now, let me elaborate couple of things about house rent allowance. Number one, many people are under the impression that the amount of rent that they have paid during the year, the entire amount is deductible as HRA, which is not true. The HRA deduction is, or rather, the calculation of HRA, allowable HRA, is quite different. Not the entire amount of rent that you have paid is considered as a deduction in the form of HRA. To compute the HRA, we need to check couple of figures, or rather three figures. Firstly, we need to see 40 or 50% of the basic. Secondly, we need to see actual amount of HRA that you have received. And thirdly, we need to see what is the rent that you have paid minus 10% of the basic. Whichever amount is lesser out of these three, that will be given to you as HRA deduction. Now, 40% or 50% of the basic, that might uh, raise certain question, to which if you are staying in a city which is a metro city, in that case, instead of looking at 40%, it will be seen 50% of your basic. If you are staying in a city which is not a metro city, in that case, 40% of the basic figure needs to be seen. Now, metro city in this context are Delhi, Mumbai, Kolkata, and Chennai. Any other cities for this purpose are not a metro city. For example, Bangalore, it is not a metro city for HRA purpose. Noida or Gurgaon, they are two are not metro city for this purpose. Second point we are trying to make is leave travel allowance. Now, leave travel allowance is an allowance where your employee gives you certain amount of allowance if you are traveling for leave within a specific period of time. Now, leave travel allowance is given to you twice in a block of 4 years, right? 2 years in a block of 4 years. The present block has started from calendar year 1st of January 2022. Now, you can travel any place within India with your dependent spouse and your children. However, one point needs to be understood that hotel expenses, meal expenses, these expenses are not covered or not allowed to be deducted as LTA, leave travel allowance. Only to and fro traveling expenses, either by a train or flight are deductible. Further, the flight should be economic class, and in case you are traveling through train, it should be either AC 3 tier, 2 tier, or AC first class. Any other class are not permitted, right? Uh, Furthermore, the uh, benefit can be taken through declaring to your payroll portal, right? Now, uh, let's come to another tax saving expenses, that is uh, interest on home loan. Now, interest on home loan gives us a very interesting idea, very interesting idea. uh, we are not going to deduct the entire interest as interest. We are going to claim the interest as loss from house property. However, there are certain conditions to which we must pay heed. First of all, in case the loan is taken for a self-occupied property, maximum amount of loss that can be claimed is 2 lakh rupees. So, in simple words, in case it is a self-occupied house property, maximum 2 lakh rupees of interest can be claimed. The principal repayment that can be claimed under ATC. Now, if this is a let out house property, that is a house property that you have taken and let it out, in that case, there is no limit of deduction, entire amount of interest that can be taken. Now, we come to a unique situation where many people face, right? So, most of us are currently staying in a different city than our hometown, right? So, in our hometown, we have purchased a flat wherein our parents are staying or our relatives are staying, and we are staying in a different city for our employment purpose. Here, in the new city, the city of employment, we have taken a house on rent. Now, many people ask this question that I have a home loan for a flat that I have purchased in my hometown, wherein my parents are staying, and I am staying in a different city for my employment purpose with my dependent family. So, in that case, can I claim HRA and home loan? To which the answer is yes. In that case, you can certainly claim home loan. Couple of points for home loan as well. Number one, the deduction on home loan, the interest component, that can be taken only when you have the possession of that house. If the house is still under construction, you cannot claim it. So many of us actually go ahead and purchase a flat which is still under construction, and during this construction period, we keep paying certain amount of interest, right? And let's assume this house is completed after 2 years. In that case, what will happen to the interest that I have paid for 2 years, right? So every year, what happens? There is no waste of interest that has been paid because there is a concept of accumulation of interest. What happens is, till the house is completed, you can accumulate all the interest that you have paid, and in the year of completion of the house, you can take the amount, and that amount will be deducted in 5 equal installment in 5 years. Now let's try to paint a picture. Firstly, let's assume I have purchased a house in 2020, right? And the house actually got completed in 2023. So 2020, I have paid, let's assume, 1 lakh rupees. 2021, again 1 lakh rupees. And 22, again 1 lakh rupees, right? So all in all, I have paid 3 lakh rupees of interest. In 2023, the house is completed and handed over to me. In the year 2023, let's assume I have paid 1 lakh 50,000 rupees of interest, right? So what will happen? How much interest will I be able to claim in year 2023? I will be able to claim 1,50,000 rupees, that is pertaining to 2023 itself. Furthermore, the 3 lakh rupees of interest that I have accumulated, right, that I can claim in 5 equal installment. So 3 lakh rupees, 5 equal installment, that will give me 60,000 rupees, right? So in 2023, I will be able to claim 1,50,000 rupees plus 60,000 rupees. But now here is a big issue. The maximum amount that I can claim as interest for self-occupied house property is 2 lakh rupees. So technically, my total interest outflow for the year for the tax purposes would be 1 lakh, rather 1,50,000 rupees plus 60,000 rupees, all in all 2 lakh 10,000 rupees, right? But my limit is 2 lakh rupees. So 10 lakh rupees loss I will not be able to claim, and I will be able to claim only 2 lakh rupees. Second point, many of us actually take a home loan with our spouse or any other person, right? And the house is also generally under both of the users, right? So one of the person, in that case what will happen is the interest and principal component will be split between these two persons, right? Again, let's try to understand this situation with an example. Let's assume you and your spouse have purchased a flat, right? And that house, that flat was purchased using a home loan, right? The home loan, in home loan document, both you and your spouse's name are appearing. Again, assuming in the year you have paid 5 lakh rupees of interest, right, and 2 lakh rupees of principal. In that case, what will happen? The 5 lakh rupees of interest will be split between you two, right? So each of you will be able to claim, or rather, the share will be 2,50,000 rupees. The principal will be again split between you two, and you will be given 1 lakh rupees. Now, 2 lakh rupees of 2,50,000 rupees of interest, again, it will be limited to 2 lakh rupees. So each of you will be able to claim 2 lakh rupees, and each of you will be able to claim 1 lakh rupees in their income tax return, right? So if you have a plan to purchase a house property, then it's a very good plan to include your spouse in the process as well, if they are earning. So you can, this can be uh, taken as a very good tax planning, and both of you can save some amount of taxes in the process. Moving on, the interest on home loan, apart from section 24B that we have talked about till now, can be claimed and under another section, which is over and above the 2 lakh rupees of 2 lakh rupees under section 24B. Now this section has a very specific scope, and this section is under 80 EEA. To take additional amount as deduction under section 80 EEA, the loan should be taken from a bank, point number one. Number two, the loan must be sanctioned between 1/4/2019 till 31st of March 2023. The stamp duty value of the property should not be more than 45 lakh rupees, and the loan should be taken to purchase of first property, right? Therefore, in case you already have a property in your name, you cannot claim a deduction under section 80A. Now, again, couple of points we need to clarify. The first property means you did not only means that you need to purchase the property, it also means that you must not be inheriting another property, right? So there might be a question in minds of some people that, all right, I am going to purchase a new property, the stamp duty value is less than 45 lakh rupees, But I have a ancestral property that is registered in my name. Will I be able to claim 80 EEA? Answer to is no, you will not be able to claim 80 EEA because you already have a property which is registered in your name. Moving on, uh, tax saving instruments under ATC. There are lot many tax saving instruments that is listed under ATC. First of all, EPF, PPF, and VPF. Now, EPF is deducted every month from your salary by your employer. PPF is a public provident fund, right? This can be opened in any of the banks, and maximum amount that can be deposited is 1,50,000 rupees. And voluntary provident fund account, again, that can be opened on your own and it can be claimed under ATC. Furthermore, children's education fee. Now, tuition fee of children can also be deducted under section ATC. However, only admission fee and actual education fee is deductible as children's tuition fee. Any other fees, such as development fees or donation to school itself, are not allowed to be deducted. Further, the education can be for schools, colleges, and university. Further, life insurance premium. Uh, if you have taken any policy and paying a premium to keep that policy in force, in that case, that premium amount will be deductible from your total income. Principal on home loan that we have discussed earlier on. If you have taken a home loan and the loan is sanctioned by a bank, and any amount of principal that you are paying off, repaying, that can be taken as deduction under ATC. Moving on, pension plan. If you have taken a pension plan from any of the insurance organization, any amount of premium that you are paying to keep the plan in force, that amount can be taken as deduction. Now, we are going to talk about three items which are deeply correlated. That is NPS. Now, NPS has a very unique feature attached to it. First of all, normal NPS contribution that is deductible under 80CCD1. Maximum amount that can be deducted is 1,50,000 rupees. However, in NPS, you can take advantage in two other ways. Number one, you can take advantage in NPS if you are investing through your employer. Number two, if you are investing exclusively in NPS, then you can also take advantage of it. How? Let's try to understand in case you are investing exclusively in NPS. Let's try to assume a picture wherein you have a home loan going on, you have some SSY investment, you have some ELSS along with EPF, right? Assume your principal on home loan is coming to 1 lakh rupees. Your ELSS is coming to 30,000 rupees, and your SSY contribution is coming to another 20,000 rupees. So all in all, your ATC limit is already exhausted. So there is no scope for you under ATC. However, at this point of time, if you start investing in NPS, in that case also, you can take deduction of additional 50,000 rupees or the actual amount that you are investing, whichever is lower, right? So in this scenario, 1 lakh rupees of home loan principal, 30,000 rupees ELSS, 20,000 rupees SSY, you have invested another 50,000 rupees or 60,000 rupees, let's assume 60,000 rupees in NPS. In that case, you will be able to take another deduction of 50,000 rupees under 80CCD 1B, and that will be coming under National Pension Scheme. Secondly, you can invest uh, 80CCD2, that is through your employer. Maximum amount of 10% can be invested through NPS through your employer, but that amount is limited to 10% of the basic. However, maximum amount that can be invested, that is 7,50,000 rupees. Now here we have a uh, understanding of tax, reducing the tax outgo by 46,800 rupees using ATC. Now, as we have discussed, uh, assuming your PF, Employer Provident Fund contribution is 28,800 rupees, ELSS contribution is 96,000 rupees, 8,000 rupees of SIP, LIC premium of 30,000 rupees. So all in all, I am getting a ATC deduction of 1,54,800 rupees. Maximum allowed is 1,50,000 rupees. 30% tax and 4% of health and education cess. I will be able to save 46,800 rupees of taxes. And again, over here, we are talking about saving the tax using NPS. We have already mentioned that 50,000 rupees maximum, if I am investing in NPS exclusively, I will be able to save. Now, let's talk about one of the important tax saving instrument, that is ELSS. Now, ELSS, the full form of ELSS is Equity Linked Savings Scheme. By its name, it is very clear that it is a mutual fund unit uh, which is linked to equities. However, it has some tax saving benefits. First of all, amount of ELSS that you are investing in can be claimed under Section 80C. Number two, out of all the tax saving instruments, it has a shortest lock in period, which is 3 years, as compared to uh, 5 years in case of tax saving FDs, right? So it has a very small lock in period as compared to other tax saving instrument. Furthermore, since ELSS are linked with the market, then uh, based on the market activity, it can give you a good return as compared to any other tax saving instruments, right? Also, you can expect around 12 to 15% of return depending on the market condition. Further, you can invest in SIP. Uh, you can invest in SIPs in ELSS. You can set aside a certain amount, say for example 2,000, 3,000 rupees every month, and that amount will be invested. Or if you want to make your life very simple, you can take the lump sum amount and invest the entire sum. Further, this is an online process, so you need not visit any office or anything. You can start investing in ELSS from convenience of your home. Furthermore, since ELSS are equity linked, all the benefits of uh, equity mutual funds are also available for ELSS, right? So after 3 years, ELSS will be treated as long-term capital asset, right? Because it is equity linked, equity oriented. Therefore, at the time of its redemption, if it is more than 3 years, then the gain up to 1 lakh rupees will not be taxed, and beyond that, 10% will be the tax rate. Now, what are the other ways we can save the taxes? First and foremost, health insurance premium. Uh, if you have taken a health insurance premium for yourself, your spouse, and your dependent children, in that case, 25,000 rupees you can save. Furthermore, if your parents are covered, then also another 25,000 rupees can be claimed. But if your parents are senior citizen, that is, they are more than 60 years of age, in that case, the limit will be extended to 50,000 rupees. Also, in case your senior citizen parents are not covered under any medical insurance, in that case, you can claim a medical expenditure that will be limited up to 50,000 rupees. Now, again, a question arises over here. One of my parent is a senior citizen, other one is not. In that case, what will happen? In that case, the limit will be extended to 50,000 rupees. In case one of your parent is more than 60 years of age, both of them can enjoy the additional benefit of 50,000 rupees. Further, what are the other tax saving option? Now, if you are suffering from a physical disability, you can claim a certain amount. You can claim a certain amount depending on the disability percentage, right? If you are spending for some medical treatment, medical expenses, in case the disability limit is more than 40% but less than 80%, in that case the amount is 75,000 rupees. If it is more than 80%, that is in case of severe disability, it will be 1,25,000 rupees. In case any of your dependent is differently abled, then again more than 40% but till 80%, it will be 75,000 rupees for their medical treatment. And if it is beyond 80%, in that case 1,25,000 rupees. And if any of you are suffering from a serious disease, right, or any dependent in your family, in that case section 80 ddb will be coming into picture and you will be able to save some taxes. For 80 ddb, certain diseases are mentioned. For example, any motor neuron disease, parkinson disease, uh, your cancers, etc., are covered under 80c. Now, over here, we are going to talk about tax saving proof submission and what is the need for tax saving proof submission. Now, every year at the beginning, you submit certain declaration, right? You say that during this year, I will be making certain deduction. They are tax saving in nature, or I will be having this much amount as tax saving expenses. However, the income tax department actually places a responsibility on your employer to check whether all these claims that you are making, whether they are genuine or not. And that is why your employers compel you to submit tax saving proofs. If you are not submitting any of the proofs for the declaration that you have already made, in that case whatever declaration you have made during the year or at the beginning of the year, it will be completely discarded and your tax computation will be done afresh. And since all the deduction, all the expenses are completely ignored, you can see a higher amount of tax outflow, tax deduction in the last couple of months of the financial year. That might mean in January, February, and March, if you have not submitted any of the proofs. In that case, you can see a lot of money being deducted as taxes, and your take home, your actual money coming in your bank account could be quite less. However, this is not the end of the world, because similar to switching between the regimes, you can claim all the deduction that you have missed at the time of filing your income tax return, right? Say for example, you are not able to get the rent receipt from your landlord in timely manner. In that case you will be able to compute the HRA on your own and claim it in your income tax return. But you must be having some sort of proof for that. You must be having some rent receipt or rental agreement which actually shows this is the amount of rent that you have actually paid. Same thing goes for LIC premiums or ELSS. If you are investing, you will be having some sort of receipt within you for you, and on the basis of that document, you can just go ahead and uh, claim all this deduction at the time of filing your income tax return. Right now, we are at the end of our session. Shortly, we will be doing a quick question and answer session. But over here, I would like to remind you a couple of things. Number one, uh, many of us switch job during the year, right? And if we are switching jobs, it is our duty to inform our present employer about our previous employment, its earning and its tax deduction. Why I'm asking you to do this is, if you are not submitting all this information to your present employer, then your present employer will think that this is your first employment for the year, and they will give you basic standard deduction, the basic exemption limit, ATC, ATD, and whatnot, everything, and compute the taxes. Wherein your previous employer has already considered every single thing at their income tax computation, right? So your current employer will be computing the taxes at a very lesser extent, and because of this discrepancy due to job switch during the year, you could end up paying a huge amount of taxes at the time of filing your income tax return. So obviously, if you are switching jobs, you are switching it for a hike. And if you are switching the job for a hike, most definitely whatever the tax that is being deducted, that will be higher, right? If your previous employer was deducting, let's say, 10,000 rupees, and you have switched the job and gotten a raise, your present employer, must be deducting taxes more than 10,000 rupees, right? But if they are computing the taxes incorrectly, in that case, your tax deduction will be lesser than 10,000 rupees, or it will be same as 10,000 rupees. However, in your heart, you know my salary has increased, my pay package has increased, therefore, I should be paying a higher amount of taxes. So, if you are under the suspicion that the amount that is being deducted is not correct, it is coming to a very lesser amount as compared to the previous employment, then you should talk to your HR and understand how you can declare the previous employer's taxes and the income, so that your tax computation is done correctly and you can file your income tax return, and at the filing of tax return there is negligible tax payment. Now this actually ends our tax filing session, or rather the session on tax saving expenses. Now we will be going live and answering the questions. Now, one question is coming up. It is saying that, can I take complete HRA exemption at the time of filing individual ITR, which I missed to claim from my employer? Yes, you can claim HRA. However, you must remember that actual amount of rent that you have paid, or the HRA component of your salary, that is not deductible. We have discussed in earlier segment of this webinar how the HRA, the deductible HRA, is computed. You can compute your HRA based on that and claim the actual amount of HRA that is allowable for you. Right. So, thanks for joining in. I hope you have some understanding of the tax saving expenses and deductions and proof submission. Thank you all for joining us. Have a great day. Bye bye.